Good afternoon, sir.
Yes, sir, you're audible.
Thank you so much, Bhavni ma'am, for a very generous introduction. And I'm really grateful to be part of this conference and really humbled and thankful to the Department of Management for organizing this and having me here. So I will just share my screen. Let me know if you can see the presentation. Is it visible, the presentation now?
Yes, sir, it's visible.
Great. So first of all, yeah, I think it's a very relevant topic, and even as we speak, the stock market currently is like all-time high, and it's very interesting topics that we have over here. So I hope the participants will gain a lot during this. And for my presentation, feel free to stop me anywhere you have any queries. And my objective here is, for this 1 hour of session is to take you to hold your hand and take you with me how we approach the auditing of a company. So exactly this would be about the perspective of an auditor, how he views the financial statement and how he approaches the work, and certifies the financial statement. So just to clear the expectation, it might not be about what you exactly see for investing in the stock. For example, whether you look into balance sheet or cash flow statement. So I will not talk about that, and I'm sure because other dignitaries following the session might pick up on that. So my objective here is to give you an auditor's perspective, that how we audit, so that you get a clear picture about what's the approach of an auditor, how he looks at the financial statement, and how the whole process of certification of financial statement works. Why that is important? Because lot of public money is invested in the companies. So if there is no independent certification, the trust and the faith of the public in large would not be there. That's why the auditors are appointed who are trained in the specialized skill, and they are very much independent of the management to give their independent opinion, so that people can have trust. And once that certifies, financial statements are issued, people are more comfortable to look at the figures as being true. So that's the importance of having the financial statement audited. So just quickly, I will go to the next slide. This is a brief introduction about myself. So I completed CA first, one of the most respected degrees in India. I failed a lot, like I failed many multiple years in CA, but I never gave up. I always had this, that whatever happens, I will still continue. So I was back with the same kind of enthusiasm every time I failed to achieve the respected CA degree. And see, once I completed my CA degree, I got into Tata Group. I started with Tata Motors. Then I went up to work with John Deere, which is a US-based company, a Fortune 100 company. And after that, I also worked in Gulf, like I worked in Bahrain, and currently I'm in Dubai and working with one of the leading companies over here. So I have worked in like manufacturing sector, in retail, in hospitality, in automobile. So I have worked reasonably in different sector, and basically my role was in audit, so internal audit, I would say. So wherein we look into the overall governance of the company and the different departments where we can add more value. And during this journey, I have been grateful to have worked in different countries. So I have been to different part of the globe, like US, South America, Australia, China, for audit purposes as well. And so yeah, and subsequently, today's world is very challenging, and one has to be very skillful to get the foot in the door. Which I mean is, at least you should get an opportunity in the company to have an interview, and then you can express yourself. So to be to survive in this competitive world, I always believed that the skill set that you have will always stay with you for your lifetime. So I invested in my career as well. So after completing CA, I also did CPA from US, which is same as CA in India. And then I also completed CIMA from UK, which is again a gold standard course in from UK in management accounting. And then other degrees like CIA, CISA, which is more into IT, informational technology audit. So again, like this was part of the journey, because as I said, it's a very competitive world and we need to upgrade our skills. And even this conference, is about upgrading our skills and being more curious, to see what things are happening around, and to add more value. So that's the introduction from my side. Moving to the next one. Yeah. So here when we again, let me take you from the place where we start the audit of a company, so that you get a holistic understanding that how our approach begins when we take up any new audit, or when we start the audit of a company. So first we look at the overall governance system. See, governance nowadays is a lot of importance, because you might see that there are a lot of companies in getting engaged in fraud, and then getting bankrupted. So governance is one thing which takes control, that overall systems are in place, overall accountability is in place, and overall the board and the management are having the best processes to ensure that whatever results the company is giving is trustworthy. So the governance is one of the most important things nowadays. So like, so what we look at when we look at a company is, overall the company has three lines of defense, right? So what I mean is, the first line of defense is their operational management, the management who is actually involved in the day-to-day activities. So, and the internal controls. What are the internal controls? Internal controls are basically, simplistically, are the policies and procedures and systems in place to do any kind of work. So in any company you might see there are a lot of policies and procedures, so that the work is consistent and people know what is expected of them to do. So if those are not clearly defined, it's a very difficult for the company to meet its objectives. So that acts as the first line of defense, is the the department who is operationally engaged in the day-to-day activities, and the policies and procedures being placed therein. So just to give you an example, what is operational management means, like, you might have a procurement department in a company. So now when we are engaging with the suppliers, we are taking some services from the outside companies. Does the procurement department has his own policies and procedures to qualify the vendors they are taking quotes from? What I mean by qualifying the vendors, basically whether they are seeing that the vendors are qualified enough to supply the goods to the material, whether they have a good background, whether they have a good market history, so that they are reliable, and whether we are taking proper quotations from the competitive suppliers, so that we don't end up with someone who we are paying the highest more for the services. So are these things are in place, that okay, the qualification is there, the competitive bids are there, and then you are choosing the best one, and the justification they are providing. So these are under the control of the department who is actually operating in the department. Then comes the internal control policies, as we spoke about, that whether all these things have been documented, and you need to not only document it, but you need to also implement this. So whether this is practically being applied in the organization or not. So that is the first line of defense. The second line of defense in the company is having a compliance department who overlooks everything, that whether we are complying with the laws, whether we are complying with the manufacturing technology. So the compliance department is the one who oversees whether those transaction has taken place correctly or not. Similarly, health and safety, quality, information security. But financial control is one of the most important second line of control. What I mean by financial control, basically it means the department of finance, when any transaction is occurring in an operational management, those transactions come back to finance for recording, authorization, and entering in the system. So the second line of defense is finance, because finance checks whether all the supporting documents are there, whether the agreements which are required with the customers or the vendors are there or not. They check whether all the policies has been complied or not. So they will do, the finance department acts as a second line of defense. And the third line of defense is internal audit. What is internal audit? Internal audit, again, is a separate team appointed by a company who does not report to the senior management. So even if you see this picture over here, the senior management is being reported is only from the operational management and the second line of defense, but the third line of defense reports directly to the board because there has to be independence. If the internal audit reports, you can see the small arrow to the senior management over here, but that means that internal audit only reports administratively to the senior management. What I mean by administratively means is day-to-day work, some kind of coordination, but they report directly to the board and audit committee. Why? Because if internal audit report to the senior management, they might be biased. They might not have so much freedom to express what they exactly feel about the transaction, because the senior management is involved in the operations, right? So you cannot report to someone who is a party, a vested party to the transaction. That's why the internal audit reports directly to the board of directors or the audit committee, which again forms, audit committee is also forming from the board members only, so that we have the internal audit have the freedom to report whatever they think fit is currently going on in the company, and there is no conflict of interest. So these three line of defense is very important in any company to see whether whatever financial statements are being produced are trustworthy, are reliable or not. And then comes the external audit. External audit is the outsider, the statutory audit which certifies the financials that they are true and fair. So basically, external, what we generally know when we say audit is external audit. When we normally talk about audited financials, we speak about external auditing, external audit certified statements, also called as statutory auditors, which audit the financial statement. So they come and check again independently whether the books of accounts are correct or not. And then we have the regulator on top of that, which would be like in this case SEBI, for example, who is taking control of all the companies. So SEBI might be the regulator overseeing all of these work. So these governance has to be there in place, because this lays the foundation of the financial statements that are being produced, because this is a system through which all the transactions go through and presented in the financial statement. So I hope the three lines of defense is clear to you guys, because this is very important in any company to have this, so that the company has a robust system of reporting. So moving to the next one, there are some myths about external auditing, like the certification of financial statements. So it's better to clear those out, that what are the realities and what are the myths. So the first one is financial accounting against management accounting. Like, what is the difference between financial accounting and management accounting? Financial accounting is about recording of the transaction and presenting it in the financial statements. So this is what exactly external audit do. They review and audit the financial statement. But management accounting is more about the efficiencies and effectiveness of the processes that you have used. So in management accounting, you all basically try to benchmark, like, okay, this was your standard, budget that might have should have been occurred, or you compare it with other companies and compare yourself how you are faring in the effectiveness and efficiency of the utilization of resources. So when we do external audit, we never look at management accounting, whether the company is efficient or effective. We only look at the financial accounting, that the figures are correctly reported or not, whether the transactions are correctly recorded, processed, and presented in the financial statement or not. So we should not mix management accounting, which I mean is the effectiveness or efficiency of usage of the resources, with the recording of the transaction. When we talk about external audit, we just check whether the transaction that has occurred has been entered in the right value and captured correctly in the financial statement or not. Now, the next one is true and fair view against detective fraud. Many people think that auditing is about detecting fraud, but it's not. Though when we audit, if we find something suspicious or areas wherein there are some voices coming in between, but anyways, so basically true and fair view means when we do the audit, we look at whether, high level, in a, like, mostly substantially the figures whatever are being reported are correct or not. We are not after, detecting frauds. We are not bloodhound, like finding trying to find faults. Our objective is to see that whether the numbers that has been reported is correct or not. And if there is suspicion, then we look into more details, and then it might be kind of an investigation to look at the whether it is a fraud or not. But the first objective is not to detect fraud. The objective is to detect whether the transactions is correct or not. If it is something suspicious, then only we go to the fraud. And because of we do it on a sample basis, it's better that we can detect all the fraud. So just to clear, because many people think auditing is just detecting fraud, but it's not about detecting fraud, but in large to see whether the numbers are correct or not. So the third one is sample based testing against absolute testing. So again, when we do audit, we never do 100% checking of all the transactions. For example, imagine Amazon have million of transactions, so we cannot check to the adequacy of each of the transactions being entered by Amazon, right? So it is always you took a reasonable approach of a sampling method. So it's not an absolute testing. When we say absolute, it's 100%. You are looking at 100% testing. But auditing is about taking a reasonable sample. So we never check 100%. We check a sample, and then accordingly we give a judgment. So you should always know that there is limitation of audits as well, because it's very difficult for an auditor, to look at the financial statement at the year end, and within a short span of maybe 30 to 90 days, give an opinion and seeing all the transactions. So it's always sample based checking, right? And the third one is, when we audit, the auditing is done based on the date of the financial statement. So we don't predict the future over here, because in the future many things might change. There might be a fire in the company, or maybe the regulation might have changed for that company, which again, for example, for a car manufacturing company, if they come up with a new norms of emission and the factory is not equipped enough, so they might go into, they might not be a going concern anymore. So when we do audit, we tell you about the status as of that date, and it does not give you an indication how they are going to perform in the future. Because many people think that auditing financial statement is also indicative of the future. In some context it is, but it is as on that date. That has to be kept in mind. Okay, so moving ahead. So what are the key requirements in an audit? What we need to have a skill set that we know exactly how to approach the audit. So one would be professional skepticism, which means that we need to be very careful, very much alert when we are doing audit, so that we are looking at all the documents, all the transactions, in a very inquisitive manner, and we know exactly what we need. Because sometimes management might come up with figures which are fake, which are unjustified. So you have to have this skepticism in mind, which is one of the most important skills, to look whether there is some evidences are contradictory to each other. If it is, then we need to invest more and see what's happening over there. We need to see whether how is the overall management, whether they are, for example, for a sales organization, if the management have a very high targets to achieve the sales, so then the people might be pressured enough, to by hook or crook to achieve those targets. So what we do over here is we check if these kind of pressures are there, which might create an opportunity to do fraud, or to falsify the statement, because they are pressure from the management. So all these things take into consideration basically. And the other most important thing as an auditor we should have a skill set I'm talking about is about professional judgment, that whether we are able to understand the company, and whether we are able to know exactly what kind of audit evidence would be the best evidence in regards to the quality of the audit evidence and the quantity, like whether it is giving you the full complete reliance, and whether how much evidence we require to say that this is the transaction is correct. So these two are very important skill sets of an auditor, which I would say is professional skepticism and professional judgment based on their training and experience. Going to the next one is how we now, once we know like what are the three lines of defense in a company and what skill sets is very important for an audit. We always do audit based on the risk, because when you do risk-based audit, you cover the most important thing in the first aspect as well. And again, as it's a sample-based approach, you always need to have a risk-based approach to see exactly how you will, approach the overall auditing of a company. So, what are the most important risks? The first one is the strategic business risk. What are these risks? Basically, all the companies have, which are the top most important risks. The strategic business risk means the risk which the company has a vision and a mission. Vision is how, where they want to go, mission is how they are going to go there. Whether these objectives are being, these are risk that these objectives might not be met. So these are called the strategic risks. So first we look at what is the strategy of the company, whether the vision mission is clearly defined, and whether those mission is clearly cascaded to each department, so that the whole company works as a cohesive unit. They work as a cohesive unit to achieve the strategy of the company. So for example, if you have a company which has a strategy, but which has not been, filtered down to the individual departments, then they will never achieve their objectives. So this is very important to see whether these objectives have been clearly defined and whether this has been percolated to the all the operational management or not. So that's the strategy business risk that we look at first. Second comes the operational risk. Operational risk is, again, the day-to-day operation, whatever might come up. For example, for a collection department, the operational risk are, customers are not responding to pay, or there are a lot of returns coming up, like you need to having a lot of sales return. So whether we have a good process for that or not. So operational risk is basically the risk which you have in a day-to-day business. For a customer service management uh, area, you see like how many open service complaints are there, and whether we are addressing it on the right time or not. So all these things come under the operational risk. The third is the legal and compliance risk, which is about having, following the country's and that specific sector's legal risk and the compliance risk. And the fourth one is the financial reporting risk, which is one of the most important, is about the financial statement risk, that whatever figures are being captured and reported in the financials might be manipulated. So whether they are good systems to capture the transactions, to process the transaction, and to report the transaction. So that comes, you need to remember that in finance, the transaction, we call it IPR, initiating, processing, and reporting. So once the transaction is initiated, how you first enter it, how you process it, and how you finally report it, whether those systems are clearly defined or not. So that comes under financial reporting risk. So these are the basic 5 or 4 main risks that we need to look into, so that we can ensure that proper controls are in place, so that the company's reporting system and management system is reliable. Okay, moving to the next one. So what are the factors that we look into? Risk-based factors. So like once I have told you about these 4 risks, now what we move ahead is we see whether the internal governance and internal controls are well defined or not. What I mean by governance, as I said, would be a proper, overview authority. For example, board of directors, whether they, there is a clear defined appointment of the board of directors. They have a clear defined schedule of meetings of the board of directors, quarterly or monthly, as the case may be, and whether the right policies and procedures are there, whether the right delegation of metrics is there. What I mean by delegation of metrics is it's a document which says which person is authorized for what transaction and to how much limit. So if these things are clearly defined, it makes it more easier and comfortable for the company to have the operations in the way they expect it to be. So if there is lack of governance, there is no lack of a clear reporting mechanism, if there is a lack of a proper authority delegation metrics, there is a lack of policies and procedures, then the chances of financial reporting getting wrong is very, very high, right? And again, many people are relying on the certified financial statement. So if the governance is not good, it means that the financial statement has a higher risk of falsification. So this is one of the most important factors that we look into. We see, okay, whether they have a clear defined governance, they have a clear organization structure, they have a clear policies and procedures or not. The second comes the inherent risk versus the inherent risk versus, what does inherent risk basically means? Inherent risk means by the nature of the transaction, it is more risky than any other transaction. I will give you an example. Like, for example, there is a coffee shop. Okay, so what does coffee shop do? They buy coffee, they make coffee, they sell coffee, right? Pretty easy, right? So there is less inherent risk over there. But if I talk about, bank financial system, bankings, and wherein they have different kind of financial instruments, they have derivatives, they have foreign exchange. So when we talk about these things like foreign exchange, having derivatives which are a bit complex, the inherent risk automatically goes higher. So compared to a coffee shop, a banking industry is having more inherent risk. Similarly, if you have cash in hand, or if you have some valuable with the company, it's more inherent risky than having a factory which, like, have all the machine installed inside the factory. Nobody can just take away and steal it, but the cash and valuables are pretty much easier, to be stolen. So these are more inherent risky. So we look at the company, that what are the most inherent risk in the companies, so that we can focus more on those areas, right? The third is the complex transaction. What I mean by complex is means, see, many companies have failed earlier because they come up very innovative ideas. And when I say innovative ideas, like even for the subprime mortgage, if you have heard, wherein there was they were making taking all the loans in the US for home loans and making into a new security mortgaged asset and again reselling it. It's a very difficult concept. Nobody was able to understand it completely. And when the things are complex, the chances of going wrong is higher. So we always look at those things which are more complex to understand, because if it's complex, the tendency to go wrong is very, very high. So we are very alert to complex things which are very, very difficult to understand. So when I say complex, it means like provisions or accruals of warranties. For example, when you buy washing machine, when you buy TV, there might be a warranty of 1 year, 2 years. Similarly for the cars, you have warranty period, right? So when a company accounts in their books for the warranty, which might come in another year, so your washing machine might deteriorate in the next year, you might call for the warranty, but then you have to adjust, the company has to adjust the revenue with the amount they are going to incur for this warranty, right? Because they can't just book the full sales amount on that year and then incur the expense because of the matching principle. So these kind of provisions are being made to ensure that the revenue is matching with the expense as well. So these are very complex. The people try to manipulate these provisions, or they try to manipulate the valuations of the investment, because now accounting standards gives you opportunity to value different investment in a different. Some might be valued at a historical cost, some investment can be valued at the market cost, depending on the nature of what you want to use it for. So again, these are complex things. We see exactly if the definition is clear enough to understand it is meant to be what it is meant to be. So basically, we look into the complex transactions and see and be more alert about it. As I said, the third one is unusual transaction. See, many times it happens that we have an unusual customer, we have a separate agreement with some kind of a supplier or a customer, wherein because of it being substantial, we have a different kind of special arrangement with him, maybe some kind of a special discount or some kind of a special payment terms. So whenever there's something unusual, like which is not normal, we look into that more, because again, if it's unusual, there are chances that the fraud might happen over there. So these are the basic factors that we look into, so that you get into, you can go into the auditor's mindset and see where things can go wrong. Our objective is to see where things can go wrong and what are the controls in place to ensure that if things can go wrong, these are the controls which will mitigate that these things does not happen. Now the next one is linked to revenue. If anything is linked to revenue, for example, linked to revenue means linked to where you are getting money, where you're getting sales. So the collection department, maybe some kind of you might have a product, different product mix, like in a factory. So every product, what their revenue is being earned for particularly that department is very, very critical, because revenue is directly hitting your financial, and it's the most important thing. So anything that is being linked to the revenue is given more importance. Then comes the market regulations. Like if the industry is very closely monitored by market regulation, like for the manufacturing industry, or the car industry, or the telecom industry. So we need to be very careful of these regulations, whether they are being taken care of or not, because otherwise the license might be cancelled of the company, and then the company may no longer be in operational in business. So that's why the market regulation is also one of the most important factors that we look into. And the last one is the change in management or systems. What is we mean that sometimes what happens that in a company, the top management gets changed, the new management comes in. So whenever these things happen, we need to be more careful that why the earlier top management has left, and why we have this new management, whether they what experience they have, and how they are going to the transition, how the transition happened. So these are very important. Similarly, if there's any change in system, which I mean is change in the enterprise resource planning system, ERP system. So if they're using SAP earlier and now they migrated to Oracle system, so whether all the data have been correctly transferred from the earlier system to the current system or not. So these things are also very, very risky, and we always look into whether if there is any change in the systems overall, because again you need to be very sure whatever transition happened from the old system to the new system is correct. So again, by these you might know exactly what we look into a company, so that we know whether the proper controls are in place to ensure the financial statement what is being produced by that company is correct. So some examples to give you more clarity about that would be segregation of duty. So for example, I am the one who is invoicing to the customer. I am raising the invoice to my customer. So I should not go and collect the money from the customer, because if I'm invoicing to him, and even if I'm collecting the money to him, I might manipulate in the invoice system. So segregation of duty means you have right people for right work. You don't mix the roles so that there is no conflict of interest. Okay. And so as I said, I am the one who is invoicing. So I should not the one who should collect. And the one who is collecting should not be the one who reports the collection in the system. So there should be a third person. Once the other person collects the money, the third person should record that the money has received, because the one who is collecting the money, if he records also that he has collected the money, he might use this to falsify or apply the receipts against another customer. So there has to be a proper segregation of duties in the work, and if it's clearly defined, it gives you better comfort of roles. The second is authorization. What does authorization? Very simple, like the preparer, the reviewer, and approver should be separate. So the one who prepares is not the one who approves the final transaction. So that is about authorization, that we have different levels: preparer, the reviewer, the one who reviews, and the finally one who authorized it to put it in the system. Now third is performance reviews. What is that? Performance review, we see like actual versus the budget, but how it has, our financial has performed with what we expected. So if there is any significant unusual thing, we always look into it, like why it is not matching with the budget. Also performance review can be actual this year with the actual last year. So how we fared this year with how we fared last year, and what are the reasoning for that. Or it might also be the performance review of the department, how they fared, like their own evaluation, like each at the year end they do the evaluation of each department about whatever their balance card score should be and how much their balance card score is now, so that where things went wrong. So these performance reviews are good internal controls. Next one is physical controls, which are like, when you want to enter any premises, you have an access card. Without access card, you cannot enter the premises. So these are like there's a good safe lock for putting the full day sales, the cash collections. So you have a secured system of putting your valuables and cash in a secured way, in a safe manner. So those are kind of example of good physical controls. The next is account reconciliation. Account reconciliation is basically that you reconcile accounts, like the bank account reconciliation, whether the amounts in the books is matching with the books in your books, is matching with the bank statement or not, or whether your individual sub ledger accounts is matching with the main ledger account or not. So these again gives you a comfort level that your accounts are correct. The next one is exceptional report. Now, what is exceptional report? Exceptional report may be some transaction happening on a weekend. So you can see the report gives you, okay, this transaction happens on the weekend when nobody was there. So how could this have happened? Or some kind of transactions, for example, where the purchase order that you raised was lesser, but the amount that you the invoiced was more. So it will show you in this report that these are the exceptions where the PO amount is lesser, but the invoice amount is higher. So these exceptional reports, if they are built in the system, they give a much more comfort level for the internal controls. And the last one is IT controls. IT is one of the most important and driving force in any company nowadays, because information and data is the key to everything, right? And in IT, there are two things. One is the general infrastructure. What I mean by general infrastructure is overall hardware systems, like that is being given to the company, to the employees, that their own laptop, their own systems, and the overall network, which network they use, what kind of hard drive they use to store the memory, and application controls. What are application controls? These are the particular softwares that you use. Like softwares nowadays is basically ERP, but with ERP you have other things like Power BI, you might have Salesforce, or you might have some customer relation management softwares. So one part is about the general IT infrastructure, and the other one is about the software. So whether the controls in the general IT infrastructure, hardware, network, memory drives are correct, and whether the application controls for the softwares, whether how the people are given access, whether they have given the right access or not, those are comes under the application control. So these are good controls if you have these things in place. Going to the next one. So now this is about the overall audit process that we do. Once we have the engagement till the completion of signing of the audit report. So I just wanted to give you pilot view of exactly what happens when an auditor is approached with an assignment. So the first is the agree to terms of engagement. What is that? We have an agreement where we clearly lay our expectations, that from an auditor side, the expectation is the management is going to prepare the financial statement. The management is going to take care of the internal control system. Our job is just to audit it and give our opinion about it. Okay. So those things are very clearly defined in the terms of engagement. Our next step is understanding the entity and its environment. Why that is important? Why understanding the entity is important is because if you don't know the background of the history of that company, it's very difficult to have a good professional judgment about whether looking at their financials, whether something is going on wrong or not. So we need to actually study the history of that company, the industry as well, and understand the overall environment. And the third step is assess the risk and internal control. Now, what is risk and internal control? Is again the governance that we talked about. Governance, here we check is again whether all the policies and procedures are clearly defined or not. But you might ask a question that when we are doing the audit, it's auditing about the numbers, right? So when we are talking about auditing about the numbers, why are we worried about the policies? Why are we worried about the internal control being there? See, that the catch over here is, I will give you another example. Like when some prospective person is looking for marriage. Okay. So whenever the bride side the people from the bright side would always want to know about the family background, about what their parents did, about what their culture has been. Why is that important? Why they always look into the background of the boy? Why do they don't just meet the boy, see whether he's good enough, whether he's whatever the questions you have in mind. Why not you directly go and ask? Like similarly, why we don't go directly and audit the financial numbers? Why we look into the policy procedures and all these things? Because internal control is the system from which the financial statement is derived. Similarly, when we ask the boy about the background, about the family, about their culture and everything, we know what he is made of, what kind of things that he is made of, so that he is the output of all those things. Similarly, the financial figures are the output of the internal control system. The transaction cannot be reported if it doesn't go through the internal reporting system. So we need to look at the internal reporting system very carefully, so that we know whatever the final numbers are being given have went through the right process. And we have one more objective over here, because when we look, the internal control is very strong. What does that mean? That if the internal control, like their policy is very clear, the way of recording is very clear, how they will record, how they will process, their reconciliation is very good, their exceptional reports they review every month, there is a good segregation of duties, like each person there is no conflict of interest, people are managing the things they are expected to, and they are not mixing the roles together. So if these things are there, then what happens? It really helps us, because when the controls are very strong, we did not test more. We will reduce our testing, because when we see the systems are robust, we did not test many transactions to satisfy ourselves. We can reduce our sample. But imagine a company where the governance structure is not clearly defined. Imagine a company where they are not reconciling their accounts. Imagine where there are no exceptional reports that they are reviewing. So in those companies, we need to review more transactions to get more comfort whether it's right or not, because there is no system, right? So when there is lack of system or a discrepancy in system, we need to look into more samples. We need to look into more transactions to give our opinion. But when there are good controls, where there are good system, then we need to look lesser. So that also helps us by looking into the controls. And again, as I said, today governance is one of the most important things. Whenever you look into the company, you need to look into the governance of the company. Who are the people? How their background have been? Because tone at the top values a lot. Tone at the top, the leadership values. If the leadership is very open, participative, it's much easier for the company to work in a certain manner and produce the results which are fair. But if the leadership is very oppressive, and they just want to meet the targets, then the things going wrong is higher. So the leadership plays a very important role. The tone at the top plays a very important role. So we always need to know who is overall, managing the company, what have been their background, what have been their history, and again, whether they have good control systems or not, how their overall infrastructure is, how they have the management reporting system. So these kind of things give you comfort about the company. So now the third one is, if you see in our process, the third stage is reliance on effectiveness of control. So whether now the control is good enough for us to rely or not. And again, as I said, based on that, based on our reliance, we see whether we need to test more or less. The next step is substantiate assets, liability, transactions, and disclosures. What does it mean? Substantiating assets, liabilities, transaction, and disclosure means we actually check. Now we go out after understanding the company, after understanding the internal control and the governance, we actually test those transactions, that whether it actually exists or not, whether the assets are there or not, whether there is any transaction that they are showing exist or not by looking into their documents, by verifying with the agreements and all supporting. So here comes the actual testing. If you see the few other parts, they're all about knowing about the company, understanding about the company, looking at their governance. But finally, now comes the major part where we actually look into the transaction and see whether it is in line with the expectations or not, in line with what we understood about the company and the industry or not. Once we do that, then we review. What does review means? We apply analytical procedures. Okay, what is that? We see different kind of ratios, whether it's gelling or not. We look into liquidity ratios, we look into turnover ratio, we look into the cost of this goods sold ratio, whether they are in line with the company and the industry's trend or not. So these analytical review gives us a hint that if the actual financial is somewhere going wrong, so after actually checking it, we do one more step of analytically reviewing it by matching it with different kind of ratios, so to see the numbers are pertinent, the numbers are fair enough from the financial. And after that, we obtain written representation from the management. What does it mean? So basically, we tell management to give us in writing that whatever transaction they knew, they have captured it correctly. And if there's anything like a fraud or anything mishappening that have happened, they have disclosed us, so that management has the accountability that they need to tell us everything that has happened to the company. They might not hide it from us. So explicitly, we need to take this from the management so that they know that they're accountable if they have hidden anything from us. So that is called the written representation that we take. And then finally, the auditor's opinion is given that whether this your audit the statement is fair, true and fair or not, or whether it is not complying with the required standards of, or the information is missing. So the final reporting aspect. So this overall process, why I wanted to take you through. See, again, I could have talked about what you look into when you look into the financial of the company, but that would have never given you a perspective to how to approach, so that these things will help you also to see what you look into the company when you want to buy that stock. So these things I wanted to talk to you about, that the 3 lines of defense. Then we talked about the risk-based approach, that what risk, like we talked about the strategic risk, we talked about the operational risk, legal risk, and finally the financial control risk. Then we talked about the different kind of risk-based audit factors in regards to the controls, governance, whether they have the right kind of physical controls, the access controls, the reconciliation. So all these things will give you a perspective that how a company should ideally work, again, because governance is one of the most important things. Testing can happen. What we do is actually testing of the transaction can happen. But if the governance is a problem, then the final output might be very difficult to verify. So I wanted to focus on the most important factors about the governance, about the risk based factors that you need to look into, so that you understand how you need to approach to see how you will really be comfortable about that company. Okay, moving to the next one. So here it says, if you see, it says that it is not the strongest of the species that survives, not the most intelligent, but the one most adaptable to change. This is from the Charles Darwin. He told you about the evolution of human, like how we evolved through the years. So it's not the smartest person and it's not the brightest also, but it's about the one who is very easy and who is very adaptable to change. Same goes with the company, with the new technology coming up, and many companies, just going away because of having the old traditional way to do work. They are vanishing. And so we need to be very, very proactive in nowadays and need to be adaptable. And that's very important for a company to go for going concern, which means they have to go for future years. But if they are not adapting well, they are going to vanish. So this goes with the companies also, that they need not be the brightest, they need not be the strongest, but you need to be the adapting well, adjusting with the environment and going with the wave. If you look at the next slide, you can see here that in 2006, these are the companies who were having the highest market capitalization. ExxonMobil, General Electrical, Microsoft, Citigroup, BP, and Royal Dutch Shell. But now, 10 years later, if you see, it has changed. Only two companies, ExxonMobil and Microsoft, is there. But all other companies are now taken lead, like Apple, Alphabet, and then Amazon and Facebook. So you never know. Like in 2025, there might be a total different listing of market capitalization. So what I want to imply here is that change, is the law of nature, and the company needs to be very adaptable. And as Warren Buffett says, he says that when I invest, I just invest in companies I understand. So if I know about the chocolate industry, it's very easy for me to understand about the chocolates, that there are a lot of kids in the country and all the kids love chocolate. So that this chocolate company will go higher. But if something is very, not clear, highly technology driven, which he does not understand, he does not invest in that. So one who is, looking to the market should always have this principle that they should know first thing that whether they understand it or not, and if they understand it, whether that company is having a long term opportunity or not. So these things have to be kept in mind. And I think we are good with the time as well for the presentation. So I thank you for the patience of going through this. Maybe I hope you drive something, because it's more about the approach and the governance factor when you look at the company. So I hope you gained something, and I'm very open to any questions that you might have. And thank you for bearing with me.
Thank you, sir. Now the session is open for question and answers. So I request all the participants to post their questions in the chat box.
So if we are good, yeah, I really appreciate your participating in this. And yeah, I hope you, the others, I welcome the other speakers as well for a great session, and looking forward to that as well.
So we have no questions. Now I call upon Dr. Chandrakant Kobragade sir to propose vote of thanks.
Sir, your voice is not audible.
So please unmute yourself. Kobragade sir, please unmute yourself. Ikharkar, sir.
Yes, ma'am.
Yes, sir. Can I proceed further, sir?
Yeah, you can let me check Mr. Arkut Purna Prasad, sir, there or not.
Yes, sir. Yes, sir. Sir has joined, sir.
Yes, sir. So you shall start with the.
Because Khobragade sir is having some problem with mic, sir.
Okay. So vote of thanks is remained still.
Yes, sir. Yes, sir. That's why I'm asking.
Okay. So let me take an opportunity to propose a formal vote of thanks. I'm really thankful to CA Sumit Puri sir from bottom of my heart on behalf of Govindra Vanjari College of Engineering and Technology that you find a time from your busy schedule and you have given a wonderful session on your today's topic. Right? So I'm really thankful, sir. You have explained all the detailed things about the topic. I'm really thankful to you, sir. Thank you, sir. Thank you very much.
Thank you, sir. Moving ahead with the second technical session, I invite Professor Leena Elmule to introduce the guest speaker. Madam, please
Leena ma'am, unmute yourself.
unmute yourself, ma'am.
Leena ma'am, please unmute yourself. Ma'am, your voice is not audible.
ते बोलून राहिली यार, ती check पण नाही
Now it is audible.
Yes, ma'am. Now it is on.
Now it's
Now
perfectly
you
fine.
can.
Now it is audible.
Yes, ma'am. Yes, ma'am.
Okay. Thank you, ma'am. So to be inspired is great, but to be an inspiration is an honor. With this quote, I extend a warm welcome to all for the second technical session. It is a great honor for me to introduce and welcome our speaker for the session, Dr. Arkot Purna Prasad, who is going to enlighten us about capital markets as a new career. Dr. Arkot Purna Prasad sir is presently working as academic head financial services and business analytics vertical at iNurture Education Solution, Bangalore. Sir is also having financial service and business analytics team in 32 universities and has a vast experience of more than 22 years in field of management. Sir has been awarded PhD from Prescott University, UK, done MPhil from Annamalai University, MTech from Karnataka State Open University, Mysore, MBA from Krishnadevaraya University, and qualified NET and KSET. Sir has done postdoctoral research in area of FMCG supply chain and pursuing research in area of unit-linked insurance plans and metal derivatives. Sir has more than 40 research papers published and presented at various national and international conferences, out of which 15 research papers have been published in Scopus and UGC Care listed journal. Out of many credentials under his name, few of them are: Sir is examiner for pre-PhD evaluation at Jain University. Sir is recognized PhD guide at CMJ University, ICF AI University, and Bharathiar University. Sir is certified insurance advisor of ICICI Prudential Life Insurance and SBI Life Insurance. Sir has also won many awards. Few of them are Aryabhatta Award in 2016 for the field of management education, management teachers Consortium's Distinguished Management Teacher Award Sankalpa 2016, International Scientist Award in Engineering, Science and Medicine Best Research Award in 2020, Award for Excellence in Education Field 2021. So, it's my privilege to once again welcome multi-potentialite Dr. Arkot Purnaprasad and hand over the session to sir. Over to you, sir.
Sir, you are not audible. Purna sir, you are not audible.
Now,
Yes, sir. Yes,
Now?
you are audible. Yes, sir, you are audible.
okay. Thank you. Shall I start with the permission of the chair?
Yes, sir. Yes, sir.
Okay. So, first of all, I would like to congratulate and appreciate the efforts of the team for doing such a wonderful program. With the blessings of Almighty and all the elders, colleagues, my students, I would like to talk about this topic, which is very, very important, capital market as a new career option. I was talking to Dr. Sunil some time back. He told, so this subject is very useful. Please do this for our students as well as for the faculty fraternity, because capital markets are becoming very, very important, and how to understand this ethically and how to take it forward. So I should thank Dr. Sunil for giving me this opportunity, and let us see, how we can learn a bit from this session. Okay. So with the permission of all, I would like to present my slides here. Please acknowledge this if you are able to see this correctly. Anybody can say whether it is visible or not? Anyone can confirm?
Yeah.
Is it visible?
No, sir.
No,
Yeah?
Not yet.
no, sir.
No,
Yeah.
sir. Not yet.
Not yet? Now, 1 minute, just a minute. I'll see what is the technical glitch in this. Now,
Yes, sir. Yes, sir.
are you able to see? Perfect.
Yes, sir.
Okay.
Yes, sir.
Fine. Thank you so much, Dr. Leena, for introducing me so beautifully to the gathering. Now, I would like to take forward with a very, very important quote. Vibrant India needs vibrant capital markets. When I say vibrant, it basically talks about how important Indian economy for the world economy, and how 1/6 of the population can contribute more to the world economy. This is what I am referring for. And I used the word called vibrant India for the simple reason, lot of youngsters are available for work in India. They are ready to work 24/7. They are ready to work for any type of assignments, whether it is a night shift or second shift or general shift, they are ready. And if I am given the support of capital markets, I'll be able to pull out a lot of things to the economy and to the country at large. So with this very, very positive note, let us understand that India is a very, very powerful country and a powerful, young country with a lot of dreams, with a lot of aspirations. Now, to move forward, basically I know capital market is divided into primary market and secondary market. What is this primary market? This is the market where financial products are made. I can say this is the production part of a financial services or finance of any company or for any country.